In this video, we're going to be covering the different types of employment gaps that can affect your ability to get a mortgage when you're trying to buy or refinance your home. We're also going to be going over the length of those gaps and the 3 things that you need to make sure you can provide and help your lender with to overcome the different employment gaps. I'm Megan Marsh of Keystone Alliance Mortgage and Keystone Capital, where our job as a mortgage broker is to empower you, educate you, and work on your behalf to help you buy a home and get a mortgage when you're refinancing and purchasing. So I know that there are a lot of you who are wondering, can you get a mortgage if you have an employment gap? And I'm sure it's concerning, or if you're, let's say, moving to different cities, or let's say in my example, taking maternity leave when you have children. So I want to make sure you understand all the different things that affect getting your mortgage, and then all those things that you're going to need to provide, which are, it can be a lot, but the important part is you can get through gaps in your employment. So first, we're going to go through the different types of employment gaps. So let's talk about for a second unemployment. And I'm sure with COVID right now, this is something that's affecting more people than it normally would be affecting. So unemployment, you cannot get a mortgage while you are on unemployment. But if you are laid off, there are ways that you can, once you are back working, still get a mortgage, which we're going to cover here once we start going into the length of time. So just regular unemployment. But those of you who are seasonally unemployed, and seasonal unemployment means, okay, you have had 2 years at least, it could be longer, where you've received unemployment. And in those cases, you actually can use the unemployment as income, but you still have to wait to close until you're back at the job working. But seasonal unemployment is almost not even considered like unemployment. Then we've got maternity leave. So for those of you who are having children or you've adopted a child, you're most likely going to be leaving work for a few weeks to a few months. And then there's also when you go back to school, or let's say you just graduated from school. You went to college and got your undergraduate degree, and now you have just entered the workforce and you don't have that 2-year work history. What does that mean for you? And maybe there's some of you, the next one is, okay, you have, in the last year, you've had 2 or 3 different jobs. So all these different things when you're moving around, changing jobs, how does it affect you getting that house that you want, the mortgage, or refinancing your current home so that you can reduce your payment or pay off your mortgage quicker? So length of time definitely is important. And I want to point out that there's all these rules in mortgages. Fannie Mae has rules, Freddie Mac has rules, FHA has rules, VA has rules. I mean, there's thousands of pages of rules. And none of the guidelines are very exactly specific, so there are gray areas. And that's why this is very important. If your gap, no matter what gap we've just talked about with the types, if that gap is usually 3 months or less, it is not going to make a huge difference. You just need to be back and employed and be able to provide 30 days of pay stub when your gap is that 3 months, 90 days or less. Once you hit the 6-month mark, that's when things do get a little trickier, because when you've had a 6-month employment gap, that's when underwriters who are looked at, and their job is to make sure that your income's going to continue. And so when underwriters look at approving someone, they are looking at you as a borrower and they're saying, what is this person done? And what is the likelihood that they're going to still be on this job in a year, in 2 years, in 3 years? 3 years is the magic number for them. They want to know and feel comfortable that your income is going to continue for the next 3 years. And so if you're over that 6-month period, that is when they're going to want to dig deeper into your employment history. So they're most likely going to want you to be on a new job that is consistent, and they're going to want you to be on that new job for 6 months before they're going to allow you to use that income to qualify. So the 3 things that in our office and on our team that we need to make sure we're sending to the underwriter right up front. You want to take control and you want to make sure that you're sending a really good explanation. So we call them in our world, the acronym is a LOE, LOX. It's a letter of explanation. So you want to make sure that you're telling the underwriter what's going on. So if you had that gap, was there a reason for it? Were you moving from California to Pennsylvania and you used a few weeks of your last vacation, and then you traveled with your family, and so you were off for 60 days before you took the new job? Making sure you're explaining to that underwriter why and when and how, and if it was an increase in pay. That is one of the most important things because it puts all the pieces together. You always have to remember that the person making the decision on if you are going to be handed $100,000, $200,000, $300,000, $500,000, they don't know anything about you. They have your social, your credit score, but they don't know any of these other pieces. And so they need to feel comfortable with what your explanation is and that your employment is going to continue. So that's why they'll start looking back. So for those of you who, let's say, went to school, the example that we used, let's say you just got your degree, they actually, underwriting looks at schooling, not just for undergraduate or masters. You could go to a tech school, you could be getting a certification. The proof that they're going to want is, were you full-time? And that's why they'll ask for transcripts, for example. They're going to want to see that you were taking a full course load. But if you were, and then we show them the diploma, you can be a week or two on a new job and be able to get qualified with that new employment as long as you have that 2 years that you were full-time as a student. When it comes down to like maternity leave, which was one of the other examples that I gave, maternity leave is an instance that you can work around. So if you've been on a certain job, let's say, and you decide to take maternity leave, we're going to want to provide a letter of explanation that you're on maternity leave. They're going to want you in your writing with a signature saying, I plan on going back to work at this date. They're going to want your employer to also state that your position is sitting there waiting for you at the same rate that you left it at. So in that maternity example, you can actually close on your mortgage while you're on maternity leave if you get the letter from yourself, the letter from the employer. So explaining these things is really important. The second thing that the underwriters are going to look for is what's called a VOE. It's a verification of employment. And it is a document that has all these boxes, and it has to independently be sent to your employer. Someone in HR, the owner of the company. Some companies even have a third party who fills them out. And this verification form, it asks when you started, what your pay rate is, when you got your last raise, if you receive overtime, bonuses, commission, any of those other things that can vary, they're going to want to ask, and this one comes up quite a bit, what is the likelihood that it's going to continue? And some employers sometimes will put, not likely. And that's an issue. They want to see that the overtime and the bonuses, not that they're guaranteed, but that it's likely that if it's available, you're still going to receive that type of income. And also that's where your employer could fill out or write that explanation in there. So receiving that with the explanation along with your letter is key to overcoming these gaps. And then the last thing is they're going to want to dig deeper into before the gap. So let's say you've been on a job for a year and a half, and before that you were laid off for 9 months. You don't have that 2 years yet since you had that 9-month gap. So what the underwriter is going to want to see is they're going to want to go further back. When was the last time you had a 2-year consecutive period where you were working for someone or you were in school? And so you're going to have to provide more documentation than the normal 2 years because they're going before then. We see this a lot, let's say, with parents who decide to stay home with their children. Let's say you've gone to school to be a nurse and you decide to stay home with your children and you take 10 years off. And then after 10 years, you decide it's time to go back to work. and you've been on a new job for a year. And at that point, you're going to purchase a home and you don't have the 2 years. Well, if we can go back and document that you got a degree, that you've worked before you had kids, and yes, you had this 10-year gap, but now you're on a stable job that has the likelihood to continue, that will allow you to be able to purchase without having the 2 years after such a huge gap. And then as a bonus, I wanted to cover one other topic related to the same things that we're discussing right now, which is, let's talk about when you're switching jobs, how your income can be affected, or maybe how you wouldn't be able to use all the income. And so that really has to do with changing jobs, job types. So one of the things that the underwriters look at is if you're changing jobs, especially if you're changing jobs in a 12-month period. Let's say you have 3 or 4 jobs in a 12-month period. That underwriter is probably not going to think you're going to stay on your current job. So that is when you're going to have to show extra proof of why did you switch jobs 3 or 4 times. Was it because you were increasing pay each time? Were you finally getting the pay that you or the job in the degree that you went to school for? So making sure you're explaining it and making sure you have a loan officer who takes the time and really fights on your behalf is very important. But that last little thing, which really revolves around this tip, is if you switch jobs and you get paid differently or your hours get reduced, that can definitely affect the amount that they can use to qualify. So let's use the example of you have a salary. So you make a salary of $48,000 a year and you get offered a position for a sales position where you're going to receive commissions and you're going to get a car allowance, and you say absolutely because you know you could potentially double your income within the next 2 years. So when you make that change, let's say that your base salary goes down from that $48,000 and it goes down to, let's say, $30,000, and after a year you've made that $30,000 base and you've also made $30,000 in commissions, and you go apply for a mortgage. The underwriter can only use the $30,000 base salary because you can only use commissions, bonuses, overtime, the car allowances, all that stuff. There has to be proof of you receiving that for 2 years, and only the guaranteed amount can be used. So if you switch jobs, even for something better, but it has those different types, one I did not mention before, 1099 income. If you switch and you're all 1099, you can't use any of it for 2 years. The only exception to this rule is if you switch within your field. Let's say you do pharmaceutical sales and you've worked for 2 years and then you switch to another company and it's pharmaceutical sales. That would be the only time that they will then allow you to use the commission overtime bonuses, but only after 1 year at the new job will they be able to do it. They won't make you wait 2 years. But that can definitely affect it. Or if you are that parent that decides to stay home for maternity leave, and when you go back, you're like, you know what, I think that I want to go down and have reduced hours. That can pose a problem. So the thing to overcome that is getting something in writing from your employer stating that they are guaranteeing you at least the 30 hours that you'll be working at this pay rate. A letter of guarantee will help you then use the now reduced hours instead of them using other methods. Now, before we close out here, COVID. So for all of you who have been affected by COVID, which is so stressful, and so hopefully you're starting to get back to work, they're looking at COVID a little differently. They are making exceptions. It's something that's new for the whole industry. So if you're concerned about it, make sure that you contact your loan officer or a loan officer on our team, and we'd be happy to walk you through, because COVID is one of the few exceptions here that there are ways to work around that, and I'm sure your employer would be willing to help you as well. So if you found value in this video, make sure you subscribe or hit the bell so you get notifications each time we release one of our videos. You can also find us on Instagram and Facebook. And if you're ready to take that next step and look into purchasing a home or refinancing your home and saving some money, there's a link in the description to our really easy and fast application so we can connect you with one of the loan officers on our team.